Most beginners pick the wrong investing platform, not because they're lazy, not because they're dumb, but because the one that feels the friendliest is statistically the worst for your money. By the end of this video, you'll know exactly which platform to sign up for today and why waiting even one more year could cost you hundreds of thousands of dollars. The last platform I'm going to show you has a feature almost nobody talks about, one that could save you from the most expensive mistake new investors make. So grab a drink, settle in, and let's sort this out. Here's the number that should make you uncomfortable. Someone who starts investing at 25 ends up with roughly 2.5 times more money at retirement than someone who starts at 35. Same contributions, same returns. The only difference is 10 years. That means the platform you pick right now isn't just a preference. It's a financial fork in the road. And most people take the wrong one. Here's what most people do. They ask a friend, they see a TikTok, and they download Robinhood. Makes sense. The app is gorgeous. Green interface, clean layout, zero commissions. Buying your first stock feels as smooth as ordering food delivery. You tap, you swipe, you own a piece of Apple. That's exactly the problem. The 2021 study out of UC Berkeley and Columbia Law School tracked 500,000 Robinhood users. What they found was startling. Robinhood users traded 40 times more frequently than comparable users on other platforms. 40 times. And all that extra trading didn't make them richer. It made them poorer. The researchers call the app's design weaponized UX. The confetti animation after your first trade. The pull to refresh gesture that mimics a slot machine arm. The red and green colors pulsing like a casino floor. Every pixel engineered to keep you tapping. Brad Barber, a finance professor at UC Davis and one of the world's leading experts on trading behavior, put it bluntly. The evidence is overwhelming. Trading more frequently leads to worse outcomes for retail investors. Warren Buffett didn't name Robinhood directly at Berkshire's 2021 annual meeting, but he didn't have to. He said it's become a very significant part of the casino aspect of the market. Then he added, I have no problem with people gambling, but I don't want a casino as a partner. Think about that. Now, Robinhood isn't evil. They genuinely expanded access. They launched a Roth IRA with a 1% match on contributions. No other major brokerage offers that. Their cash sweep rate sits around 5%. Those are real features, but their revenue model tells a different story. In 2020, Robinhood earned $687 million from payment for order flow. That's roughly 80% of their total revenue. They sell your trade data to market makers like Citadel Securities. You're not the customer, you're the product. And then there's the human cost. In June 2020, a 20-year-old University of Nebraska student named Alex Kern saw a negative balance of $730,000 in his Robinhood account. He didn't understand it was a temporary display glitch from options trading. The actual loss was far smaller. He took his own life. His final note asked how a 20-year-old with no income was able to get assigned almost $1 million in leverage. Frictionless isn't the same as safe. A platform designed to remove every barrier also removes the speed bumps that make you slow down and think. So if Robinhood is the flashy trap, what should you actually use? Here's where it gets interesting. Fidelity was founded in 1946. It manages over $14 trillion in assets. It serves 51 million individual investors, and it's still privately owned by the Johnson family. No quarterly earnings pressure, no Wall Street shareholders demanding growth hacks. If Robinhood is an arcade, Fidelity is a library. The kind where you walk in overwhelmed, find a quiet desk, open your laptop, and something clicks. Picture this. You open a Fidelity account. You navigate to the fund screener and type in FCRUX. That's the Fidelity Total Market Index Fund. You look at the expense ratio line. It says 0. Not low, not almost 0. Literally 0. In August 2018, Fidelity became the first company in history to offer index funds that charge nothing to hold. Vanguard, the previous low-cost champion, still charges 3 to 4 basis points. Fidelity charges nothing. There's a catch worth knowing. Those 0 funds are proprietary. If you ever leave Fidelity, you can't transfer them. You'd have to sell, which could trigger capital gains taxes. It's a subtle lock-in, but if you're starting out and planning to stay, it's the cheapest way to own the entire market. Marcus Garrett, a personal finance writer and author of Debt Free or Die Trying, opened his first Roth IRA at Fidelity in his mid-20s with $100. He pulled up the retirement calculator, typed in $100 a month, and set the end date to age 65. He said he literally sat there in silence for a minute. One screen, one calculation, a different life trajectory. He went on to become a financial literacy educator, and the data backs this up. A 2023 Dalbar study found that investors on platforms with strong educational tools and fewer gamification elements outperformed those on high-frequency platforms by 1.5 to 2.3% annually over 10 years. That doesn't sound like much, but compound that gap over 30 years on a $10,000 starting investment, and you're looking at $15,000 to $20,000 in lost wealth just from picking the wrong app. Every year you spend on the wrong platform, that gap widens, and it never closes. Fidelity also has 200 physical branches. You can walk in, sit down with a human being, and open your first Roth IRA for free. Most Gen Z investors don't even know that's possible. If you're finding this useful, hit subscribe. I make videos like this every week. And the best part is coming up right now. Okay, remember how I said there's one feature almost nobody talks about? Here it is. Charles Schwab was a dyslexic kid from Woodland, California, who struggled through school. In the early 1970s, he sat in a doctor's waiting room reading a Forbes article about mutual funds. He didn't have enough money to invest. The whole financial system felt like a locked door. So in 1974, he opened a discount brokerage in San Francisco, charging $70 for trades that cost $500 at traditional firms. Wall Street called him a bucket shop. He later wrote in his memoir, Invested, "My dyslexia meant I processed information differently. I couldn't read a balance sheet the way others could, but I could see patterns and opportunities they missed. That outsider's view became my greatest asset." He built the entire company to simplify what the industry made deliberately complex. Today, Schwab manages $9.7 trillion in client assets across 400 branches. But here's the feature that makes Schwab the best platform for a nervous beginner. Paper trading. When Schwab acquired TD Ameritrade for $26 billion, they inherited Thinkorswim, one of the most powerful trading platforms ever built. Originally designed for professional options traders, and buried inside it is a full market simulation where you trade with fake money in real time. You pick a stock. You place a trade. You watch it move with the actual market. The price drops 8% in an hour and your stomach clenches. You hover over the sell button. Your palms go damp. And then you remember, it's not real. You learn what fear does to your decisions, and it costs you nothing. Neither Robinhood nor Fidelity offers anything like this. Think about what that means. You can make every classic beginner mistake: panic selling, chasing a hot tip, going all in on one stock, and lose $0 real dollars. You build the muscle memory of staying calm before your actual money is ever at risk. That one feature alone could save you more than every fee comparison combined. Schwab also comes with integrated banking. Their checking account has no foreign transaction fees and unlimited ATM reimbursements worldwide. Huge for college students or anyone who travels. Now, Schwab isn't perfect. In 2022, the SEC hit them with a $187 million settlement because their robo-advisor held a cash allocation that quietly dragged down returns without adequate disclosure. No platform is perfectly aligned with your interests. They're all businesses. But the core brokerage account, the paper trading, the education. For a beginner who's nervous about that first real trade, nothing else comes close. So, there you go. 3 platforms, 3 very different stories. Robinhood looks the friendliest, but is designed to make you trade yourself into worse returns. Fidelity is the quiet powerhouse. Zero-cost funds, real education, and a culture that rewards patience. And Schwab, the one that looks the most old school, has the single feature that protects beginners most: a place to practice before a single real dollar is at risk. The platform that feels the easiest isn't the one that serves you best. The one that makes you slow down, learn, and think. That's the one that builds wealth. And every day you wait to get on the right one, the math works a little less in your favor. If this helped you see things differently, share it with someone who's about to open their first account. And subscribe. Next week, I'm breaking down exactly how to build your first 3 fund portfolio from scratch, step by step. I'll see you there.